should get rid of that 3% interest rate on that house that you have. What is this guy talking about? Why would I ever get rid of a 3% rate? I know you're gonna keep it for the rest of your life, but guess what? Things change. Your needs might change. And I feel like there's a lot of people that feel stuck right now because they have such a low interest rate and they never want to get rid of that house, even though maybe the house is shrinking around you. Maybe it's too big now and you don't need that big of a house. There's lots of reasons why you might need to get out of that house and get into another one. Again, there's several reasons why people move. Everyone is stuck in this mindset of I can never ever get rid of my low interest rate, my 2.5%, my 3%, whatever it is. It's a psychological thing that you never want to give up that low interest rate. And trust me, I get it. I have low rates myself and I love my low interest rate mortgages that I got back in 2020. And those don't exist right now, right? We're paying, up to 5, 6, sometimes over 7% on mortgages because that's the world that we live in now. But I want to show you how you can still buy a new house even in today's interest rates and probably even save some money along the way. The example I have today, it's not actually saving money, but it's going to show you how you can move up from basically a $500,000 house to an $850,000 house by only spending a couple $100 more out of pocket. Keep in mind, I'm sharing a worst case scenario one, where again, you're moving up from a 500 to an 850K house by only spending a couple $100 more. I've ran this exercise with other people, and in some cases, you actually spend less money by moving up to a bigger house, by paying a higher interest rate, by going from 3% to 6.5%. So how is that possible? Because of mortgage math. We're gonna get into it. It's all kinds of fun stuff. But it only works if you have debt. So if you are one of those individuals that is absolutely debt-free, I'm talking no auto loan payments, no credit card debts, you just have a mortgage, this video is not for you. Just skip it, move on to the next one. But if you're like thousands of Americans right now where you're tons of credit card debt, or maybe just more than you're comfortable with, more debt than you would like, and you're not really sure how you're gonna get rid of it, and you're a homeowner, keep watching. I'm gonna show you how we can use this to your advantage and possibly help get you even into a bigger house or a better house or a more expensive house, however you wanna look at it. So let's just take a little picture in the past few years, right? So I've got a little graph I want to share with you regarding the entire United States personal saving rates compared to just a few years ago, back in 2020 during COVID times, as well as credit card balances and overall. I mean, out the gates, you can already see some very drastic things in this graph, but I'm going to break it down for you. And then the little gray bar that you see there, that is the recession or COVID, right? COVID's the easiest way to say it. And keep in mind, we don't know when recessions are because the data on them is always after the fact. In 2020, we didn't know we were going through a recession until a couple of years later when the data came out, and that's how they get that information. Diving into it, you can see personal saving rates, and this is in percentages, pretty much flat, up until the recession or when COVID. And then you can see a massive spike in overall savings. It went up from 10% to around 35% put into your savings. And so why is that? The easiest way to look at it is stimulus money, right? The government was writing checks. We're paying the price for it now, but they were giving out money. So what did most Americans do with that money? Put it in their savings account because the world shut down. You can't go out. We were in lockdown. You couldn't spend that money. I mean, you could on Amazon and stuff like that. But for the most part, people saved it. And the smart ones, if you can really see, look at the graph below. This is credit card balances in billions of dollars. So you see that, we were on a kind of a pretty steady rise overall in the US. And then we saw it go down the same time savings went up. So what that means is a lot of people took that money that they got from their stimulus checks in their personal savings account and applied it towards their credit card balances, which is great, right? That's awesome. You're paying off credit card debt. We had free money from the government to do it. That was a very smart use of that money for those of you that got it. And then we saw a couple other little spikes. We saw those two other spikes that you see on the personal savings rate. Those were the two additional stimulus checks that we got in 2021. But you'll notice that that money didn't last as long as the first one. Even though you had to wear a mask, we weren't in shutdown order. So you could still go out and spend money and go to restaurants. Remember what a weird time, right? Like you had to wear a mask at the front of the restaurant, and then when you got to your table, all of a sudden the air was clean and you could take it off and eat. It was amazing, right? Science just was out the door during that time frame. It was so much fun. So again, we saw those spikes in income because of the stimulus checks, but the spending went really fast. And then you'll also notice people started to increase their credit card debt, and it's been on a very, very high increase since that time frame, since the last stimulus check, while savings has been on the opposite trend. So in the United States, over the past few years here, we we've been seeing a lot of the savings go down, credit card debt and credit card usage go up. They got used to that lifestyle of spending money again. We were shut down for 2 years. Let's spend that money. Let's get whatever we want. And then everything went crazy, right? Interest rates went high. The interest rate for your credit card was around 14%. Well, guess what? Now it's over 22%. 24%. Same thing with home equity lines, right? Back in January of 22, they were probably around 5, 6%, 4% sometimes on equity lines. Now, 10, 12, 13% sometimes. So interest rates have gone up, things are more expensive. Overall, right, inflation was another big cause of this. Inflation has gone up, life is more expensive. But we don't want to downgrade our lifestyle, so we just throw it on a credit card, because that's the American way. That's what everyone's doing. The other crazy thing is nowadays your average car payment is over $800 a month. Who has a car payment that's over $800 a month? Anyone? Just hit me up in the comments. That's over double from where it was 3 years ago. On top of that, 17% of those that have car payments over $1,000 per month. $1,000 in car payments. To me, that's crazy. And then on top of that, they're longer terms. Most people on average get an auto loan, 5, 6 years on average. I've heard you can sometimes get like 7-year auto loans. So again, we're pushing it out further, so you have to pay it longer and the payments are higher. So what does this mean? Affordability is getting harder and harder. I'm just talking you into that 2% mortgage, why you never want to get rid of it, because everything else is so expensive, right? Oh. Gotta look at the big picture. Gotta look at all of it. But before we look at the big picture, let's look at the average loan to value. This is a fun little acronym we use in the mortgage world called LTV, loan to value. Basically means how much of a loan you have compared to what the actual value is of your house. And then that difference in between is your equity. So let's say you have a $200,000 loan on your property, but it's worth $300,000. That number in between, the difference, 100,000, that's your equity. Looking at the average equity across the United States, as of the most recent data that I have, the average person has around $231,000 of equity in their home. Now, does that mean that you can borrow $231,000? Unfortunately, it doesn't. You typically can't always borrow 100% of that equity. You can only borrow up to a percentage of it. Usually it's 80%. It's something called a cash out refinance, when you get a refinance for higher than what your loan balance is. So you're borrowing more money, accessing that. For cash out purposes, and as far as money that you could actually borrow from your house, on average is around $185,000 per black night, which is, one of the biggest home buyers in the US right now. So keep that in mind. So your average homeowner in America right now has $185,000 that they could potentially tap into. Well, why would we want to tap into that? Lots of different reasons why. But for our purposes today, I want to show you what we can do with this when it comes to buying that next house. But before we do that, I want to talk about your blended rate. Do you really have a 3% mortgage? Sure, absolutely. If your mortgage is at 3%, that's awesome. But let's look at everything, right? We already talked about how your credit card interest rates are probably 22, 24%. So if we look at all of it, if you look at your mortgage, credit cards, everything all put together, that will give you something called your blended rate based on how much you actually owe on all of those credit cards. So here's a perfect example right here, right? This guy has a mortgage of, $343K at 3%, but he's got 1, 2, 3, 4, 5 credit cards all sitting over 20%. So when we add it all together, that total amount of money that he needs to pay back is actually paying over 6% total in his or her blended rate, right? So that's something you want to look at. When was the last time you looked at what your blended rate is? I guarantee you can tell me what your interest rate is on your mortgage if it's less than 4%. But what's the interest rate on every single one of the credit cards that you use daily? What's your auto loan interest rate? I bet you don't know those numbers. Most people don't. I don't know mine. I couldn't tell you what my credit card interest rates are. Something to think about. And this is an exercise I can do with anyone. It's called your blended rate. Figure out what it is. So now let's look at selling that house that has that nice low 3% interest rate and getting into a higher interest rate. So let's say your rate's 3%. Today's rate is right around 6.75%. You bought the house originally 6 years ago for $500K with a loan amount of $400,000. Your current home value as of now, it's been 6 years, is up to $695,000, and you only owe $343,000. Well, if you were to sell that house, you got to factor in the cost of selling, so that's going to be about $35,000, which means when it's all said and done, that would give you about $317,000 in money when you sell that house. Now, you're gonna have closing costs with the new house, so let's just say they're $12,000, and now you've got a down payment that you could do of $305,000. Pretty good chunk down. So here we go. So now you want to buy that $850,000 house. You have $305,000 as a big fat down payment. Let's go. You're only financing $545. That's only about $145K more than what your first loan was. Pretty sweet, right? Well, guess what? Payment shock. I get this one all the time, especially if you have a 3% interest rate on a lower mortgage and now you're looking at a higher price with a almost double, probably more than double interest rate. You're gonna get payment shock because that payment is gonna go up $2,572 per month, almost $2,600 more per month out of your pocket every single month to buy this fancy house. That's a scary number, right? $2,600, I think, is that scaring anyone right now? I don't want to spend an extra $2,600 a month. I'll just stay here, right? And that's, I think, what most people are doing. Well, you're not looking at the full picture, guys. Let's look at all of it. Do you have debt? And again, if you don't have debt, this isn't for you. Why are you still watching? Get out of here. If you have debt, this is where we can use this to make sense. Because again, in your head, would you want to handle an extra $2,600 a month to buy that house? Hell no. Most people on average are just like, screw that. It's not worth it. I'll stay where I'm at. Let's look into it, right? Based on everything that we talked about, yeah, you'd be spending $2,572 extra per month on that mortgage. You've got other debts. It's gonna put you in a tight spot. But I want you to look at these numbers right here. That's 64% LTV. Remember what LTV stood for? Loan to value. The loan compared to your value. What we can do in mortgage, and as of right now, with that fat down payment that you'd be doing, you're at a 64% loan to value percentage. In mortgage, you can finance up to 80% loan to value, 20% down, right? And still not pay mortgage insurance. So there's not additional costs or things like that. And if we were to add in all of this dude's debt, instead of putting the entire amount of money towards the down payment and getting that really high, more monthly payment in addition to all that debt. Well, let's take some of that extra money that you made from the sale of the house. Instead of putting it down, let's pay off your debt. In fact, let's pay it all off. Check this out. So now this individual, same one that we shared before, we're gonna pay off about $100,000 worth of debt. So you're gonna do $100,000 less down, which is obviously gonna give you a higher monthly mortgage payment, right? But let's look here, overall total cash flow, total amount of money that you're now spending out of pocket. In this particular scenario, in this example, now it's only gonna cost $286 per month more to buy an $850,000 house, to move up. And guess what? You're completely out of debt. You don't have credit card debts, auto loans, all of it's gone. You just have the mortgage. And if you do the math compared to what you were paying between all your credit cards, auto loans, and everything, compared to the new one, with paying that all off, the difference is $286. So does that make sense? Would you move up into a much nicer house that would fit your needs to everything that you need for only $286 more per month? Even though the interest rate is almost double? You don't care about the interest rate. You care about what you pay every month. That's the number I want you to start paying attention to, because that's the number that leaves your bank account. Do you know what you pay in your interest every month? No. You just know what the dollar amount is that leaves your bank account. So that's what I'm saying. Just look at all of it and don't get stuck in that psychological thing of, oh, I have to give up my 3% interest rate. If it puts you in a better situation, great. And again, I've done this example with a lot of people where it's actually positive, meaning that it would cost you less money to buy a bigger house with a higher interest rate. Crazy, right? Again, paying off debt, using that money wisely and allocating those dollars correctly to the right place. This is why having a loan advisor is such a big difference than just calling a random mortgage company and asking what their interest rate is. I take it a step further. If you'd like to know what you could do, maybe this is your situation or something similar, I can plug all your numbers, your entire situation, and run this exact same exercise for you just to see what it looks like, to see if we could actually save you money to buy a different house. It's math, mortgage math, right? It's so much fun. But numbers don't lie, and if it doesn't make sense, I'll be the first one to tell you. If your house is no longer fitting the needs of your family, if it's just not working, you've got some debt, you're not sure how you're gonna get out of it, you're really looking to buy a new place, let me do this for you. Give me a call today, 10 to 15 minute quick phone call. There is no judgment ever. I have been in crazy amount of debts before, and luckily I had some home equity to help get me out of it and put me in a better situation. And that's why I share this stuff with you today, because I've done it too. And it's helped me live a much calmer life, knowing that I don't have all this extra looming debt and trying to figure out how I'm gonna pay for next month. This will put you in a better situation. Or even if you don't need to sell your house. If your house is great and it works for you right now and you do have a ton of debt, but a decent amount of equity, we can do this with a refinance as well. You don't technically have to sell it in order to do this. Let's make it happen for you. Don't worry about that 3% interest rate.